Inventory in Vancouver has spiked to a 4-year high. And today, we're going to analyze why this happened and if the sudden shift is expected to continue. Because if it does, you will see a change, a shift in the marketplace as a whole, creating a lot more options for buyers and a potential wake-up call for sellers out there. The April 2024 Vancouver real estate stats are out, and we are going to dive into them right now. Off the top, we always talk about the sales volumes, essentially the health of the marketplace. Well, last month in April, we saw 2,830 homes sell. Well, how does that compare to last year and last month? Sales are actually up from last year, but only nominally, about 3% higher than April of 2023, and definitely higher than last month, 17% more home sales than we saw in March. So that upward trend, typical in this type of season, and we are seeing it again this year right now. Pull back though, let's see that 10-year average, and sales volumes, well, they're still low at about 12% under that long-term average. And while this is the fourth straight month in a row of increases, it's grinding upwards and it still feels really quite sluggish. And for an even bigger reference, well, check this out. There were more sales for the month of April going back to the global financial crisis of 2007 and 2008. Okay, so when the world was financially falling apart and everyone thought they were losing their job for good, there were still more homes sold then than there were last month. So definitely slow overall.
The new listings, this is where things get very, very interesting. And there's nothing nominal about these numbers here. So there were 7,092 new listings in April. That's 65% more than April of 2023 and 40% more than last month. What's also very interesting is that this was 26% above the 10-year seasonal average. And remember that last month was 10% below the 10-year average. This is in 1 month we've seen this huge shift take place. And we haven't said above anything, the long-term averages, in a very, very long time. This is a really dramatic change in the marketplace in just 1 month. It's a 3-year high in monthly new listings dating back to May of 2021, which was an insane year in real estate. So I think it begs the question, why are things spiking right now? And in particular, why is inventory spiking? Well, I've got a bit of a theory, and we'll see how it pans out here. But I think and I'll get into this a little bit more, but there are other macroeconomic factors that are influencing our marketplace right now that we need to become very aware of. But first of all, we need to acknowledge that the Bank of Canada tends to move in lockstep with the US. So let's not forget that over 50% of our global imports come from the US alone. So we're very much tied to that economy. And everything that we do largely depends on what they do. With that said, it's influencing our economy. And here's how, or at least here how I think. January and February were strong selling months, as buyers who were hedging their rate cut expectations decided to make moves in the early part of the year. Sellers gained some traction at that point, and units sold, and sellers were getting wind of this movement. So as we moved through the early months and sales trended well, sellers started coming to market to try and capture that activity. In fact, a lot of sellers that had put off plans in 2023 were coming into the marketplace in 2024 with the expectation of kind of getting back to a recovery or back to where they thought the market might be. And if you go back to December, there were calls for 5 to 6 rate cuts from all kinds of pundits, economists, industry professionals. They were calling for cuts as early as March, some in April. We didn't agree with that call. We also didn't make it. We thought it was going to be much later in the year. But nevertheless, sellers geared up to kind of meet that expectation. And the issue that sort of unraveled was that when March rolled around, no rate cuts came. In fact, quite the opposite. But nevertheless, more and more sellers kept coming to the marketplace, and clearly a lot of them arriving in March and here in April. As buyers continued to pay close attention to interest rates, and they were bound by the lack of affordability and extremely sensitive to their prices. So, I think what was happening here is we were starting to see this mixture of unaffordability, rate cut expectations that didn't show up, and buyers just hit the brakes. They said, well, hold on a second here. I don't have much room to move, so I'm not going to move right now. So that propelled things, into a bit of a stalemate here, and we started to see inventory climb. Then we started getting announcements that inflation in the US and Canada was a little stickier than anticipated, especially in the US. Rate cut expectations in the US dropped down to 2 rate cuts, and now possibly none. And buyers have reacted by saying, well, we still need to wait until rates cut so that we can pay more, so that we have more bandwidth to purchase a property if prices aren't going to move. However, more sellers kept coming to the market, and for different reasons too. They weren't all just, hedging and trying to figure out if this was a good time. They were also maybe having babies and, families expanding, all that kind of stuff. So what we saw was really, buyers and sellers trying to come together, but arguably, sellers having purchased probably in the past 3 or 4 years, purchasing at all-time highs, needing to get a certain number in order to move on, and buyers just not being able to get there based on current interest rates. And we saw more and more sellers come to the marketplace, and it's kind of saturated the market as we've known it, and buyers peeled back, waiting for more, more guidance from the Bank of Canada in terms of when things are going to change. And so I think that kind of brought us to where we are today. However, that's, I think, just one piece of where we're at, because we'd be here all day if we talked about all the factors that influence that.
One thing that definitely, I think, influenced the market last month is, of course, the fact that May 1st indicates the beginning of the Airbnb ban, or at least the restrictions that have come into place. So if you've owned that secondary investment property and you say, look, I'm making $4,000 a month right now on average, and if I have to turn that into long-term and only get $2,600, well, that spread is enough to put me underwater monthly. I don't want to feed this property, so I'm going to list it. So they would have juiced their short-term rentals all the way up until the end of April, and then listed it in April, knowing that you would probably get a buyer in the month of May type of thing. So there's going to be a small contingent of that. But what's interesting there is I dug a little deeper and thought, okay, well, the vast majority of rental properties in Vancouver are, of course, condos. So was it just a condo spike that we saw last month? It actually wasn't. It was very evenly spread out between condos, attached properties, and detached. All 3 types of homes spiked in inventory. But for sure, definitely, I think some people unloaded or are trying to unload some of their Airbnb units into the marketplace. Second, of course, like Ryan alluded to, it's a rising market. We've seen prices increase for a couple months. We've seen sales volumes increase for a few months here. And sellers predominantly here, they're going to feel a bit more confident in selling in an uprising marketplace. As we know, real estate consumer sentiment has been rising for about 6 months now. That's an environment where people say, okay, now's the time to sell. People don't like selling in a downwards market, and understandably so. What else could potentially be happening here? And we will find out as the months go on, because obviously this might be an outlier, right? One data point does not make a trend, so we're watching this one closely. But some homeowners may ultimately now be hitting that breaking point, and they need to sell to stay solvent, right? We're 2 years into this rate hiking cycle. We've seen 9 months in a row at 5% overnight rate. And all of the recent talks of potential no cuts until the end of 2025, until 2025, could sway somebody's decision in saying, look, I can't sustain another 8 months of my current mortgage payment. Or the fact that they realize that, look, even if there are cuts, there might only be 1 or 2 this year, meaning will 50 bips or even 100 basis points cut bring somebody back into the affordability level of their mortgage. So there could be that contingent of the marketplace that says, look, we've stretched as long as we can. We can't anymore. We need to downsize or rent or leave. So I think there would be a proportion of the marketplace that brought their homes to market in the month of April, resulting in that spike.
Yeah. And I don't think we're just seeing it here too. I'm starting to read articles out of the States right now where you're seeing places like California, Austin, Texas, and Florida seeing a surge in listings as well. And it just so happens that those three huge states also have the highest level of credit card delinquencies in the US as well. So again, affordability is not just here, it's across the whole Northern Hemisphere. And it's a matter of time, I think, before we start to see, again, a little bit of, probably a little bit of a correction here in the short run. And so I guess it kind of begs the question is, what are we going to see in May and going forward? And I want to kind of touch on May, certainly, but I want to bring some other things to your attention, which is the macroeconomics that I think we need to really pay some attention to. It's very hard to predict where we're going to go from here, considering how temperamental the marketplace is. I do think the Bank of Canada will begin cutting rates in June because the overall Canadian economic performance and GDP output is stagnant, especially on a per capita basis. It continues to fall to new lower lows. And we have to recognize that housing performance is a result of our overall economic performance. So just hear me out for a sec. As Canada continues to see a flight of talent and investment leave the country to other places in the world where they won't be taxed under something like the new capital gains taxes and other restrictive policy measures, it's a matter of time before our economy falls completely flat, which is just about there now, and fiscal policy is forced to change. Like it or not, Canada is first and foremost a resource-based economy, and our current government has done everything in their power to stifle Canada's main way of making money. Instead, we've tried to trade it in for a knowledge-based economy, and that puts us in competition with other countries that have much more power and much longer-term investment in these areas. We're just not using our own competitive advantage on the world stage because our government has chosen a perceived moral high ground that has resulted really in punishing Canadians economically. Business leaders are saying as much too. In a 2023 survey of North American energy sector executives by the Fraser Institute, 68% of respondents were deterred by the uncertainty concerning environmental regulations compared to 41% in the States. And then mining executives, 98% of them said their companies require more investment, government commitment, favorable tax policies to support their growth. And then in the transportation side, 56% expressed dissatisfaction with the regulatory framework. In fact, Canada's overall, the positive sentiment in Canada's overall business environment has hit its lowest level, which is 20% since the inception of the survey back in 2017. The result of these policies and regulatory burdens from our current federal and provincial governments, tied in with weak commodities market, has created a somewhat predictable outcome, and that's that there's been a huge fall in investment in Canada, especially in the resource sector. Just check out some of these numbers. In 2015, the inventory held $711 billion in major projects. And by 2023, that had fallen to $572 billion. Oil and gas, they had 155 major projects worth $456 billion back in 2015. Forward to today, we're down to $319 billion. That's a 43% drop. Electricity sector, $156 billion in 2014 in capital projects. That's now down to $98 billion. That's a 49% drop. And if you look at the mining sector, the things we need to make your phones, your electric cars, all that kind of stuff, $166 billion in capital projects in 2014, down to $93 billion. That's a 55% drop. So here's my last kind of thoughts on this. Canada is rich in natural resources, and we have all the tools we need to get us out of this ridiculous tailspin that we find ourselves in. We have an abundant natural resource sector, and we can provide a smooth transition over to that renewable energy sector as well. We have more natural gas and uranium deposits for nuclear energy and all this kind of stuff, but we just aren't using it. We're not using our competitive advantage. And if our government could stop denying this reality and begin to actually support these industries, we would see a robust return to our economy. But instead, they focused on driving up international student applications, massively inflating our population growth and increasing taxes because they can't get revenue out of the other sectors because they screwed them up. So instead of encouraging housing supply and being able to offer all kinds of rebates and being able to offer incentives, they're cash strapped. And so they have been taxing now more and more people that come to the country as the solution. So I don't think we're going to see any kind of turnaround by May. In fact, I don't think we'll see it by June either. I think it's going to take some time before we see a return to the robust economy that we've seen before, but it's going to take a different kind of leadership. And I think we could expect a lot of what we're seeing now going forward until that change takes place.
All right. So my take on, are we going to see similar numbers in May and June, or was April kind of a one-off? Well, to me, the answer to that question lies in another question, and that's what percentage of the real estate market is truly struggling? We know that about 50% of homeowners have no mortgage, and 25% of the remaining have 20% or more equity in their home. Pretty stable environment, right? Well, let's look further. Mortgage insolvencies remain near their all-time low at 0.18%. We'll have the February numbers for that out next week, and I do expect them to increase to maybe 0.2%. Still well below, of course, the pre-COVID numbers of 0.25%. But there are a lot of other insolvencies that are taking place across the landscape right now that are much more worrisome. The fresh insolvency data for March was published just this morning from the Office of the Superintendent of Bankruptcy, with a couple of highlights, including consumer insolvencies are up 19% year over year. But check this one out. Business insolvencies are up basically 57% year over year. Right now, businesses are being crushed. And the more that businesses fail, the more people are laid off. The more people that are laid off, the more people cannot pay their mortgage. So could you imagine being in a household of two people and you're already stretched, and then suddenly your income is cut in half or so? Well, if you have to sell, what are you going to do next? I guess you're either going to downsize. Well, that doesn't add any inventory to the marketplace. That's one sale and one purchase. So are you then leaving the area or renting, which of course, both of those would result in higher overall inventory? I think honestly, there's going to be a little bit of both taking place. We know that in 2023, we saw the highest number of people ever leave the province of British Columbia. And that trend may very well continue, as we are not seeing any level of increased affordability within this province. Overall, the percentage of renters in our province is increasing as well. If we look back to 2011, about 51.5% of residents were renters. 10 years later, that had increased to 54.5%. Now, let's look back here. The largest spike in inventory ever recorded was seen during the global financial crisis. In December of 2007, there were 8,200 listings. By September, 9 months later, that had hit an all-time high of 20,600 listings. Okay, almost a 12,000 inventory spike in that time. But the thing is, that inventory was completely absorbed just another 14 months later, by December of 2019, where it had dropped back down to 8,900. So I think we're going to see a slightly elevated increase in May and June, with levels tapering off during the summer months. Lastly, though, the per capita GDP numbers have been negative now for 7 straight quarters. And just today, the USA reported a weaker than expected jobs number for April, with their unemployment number ticking up just slightly. So while I don't expect a frenzy of buying after the first rate cut, it will increase sentiment, which is still going higher, real estate sentiment that is, which will result in higher sales volumes. So ultimately, I think I'm calling this a bit of a one-off. I think we're going to see obviously increased inventory, but not to a level that's going to quote unquote crash the market. Take that for what it means. But let's talk now. Let's get back to the numbers, right? We talked about a massive spike in new listings. Well, what does that do to our inventory? Inventory is up 42% year over year to about 12,500. Okay, that's 15% higher than it was last month and 16% above that 10-year average. So we now are sitting on a 4-year high in inventory. Okay, 16% above that 10-year average. Well, if you remember, last month was 6% above the 10-year average. February was 3% above the 10-year average. And January was just below the 10-year average at like 0.3% under. So we basically started this year with normal inventory levels that have now been trending upwards for 4 straight months. When we talk about the 10-year average, it does include 2 of the most bullish real estate markets we've ever seen. If you were in the market, remember 2016 and 2017, oh my gosh, that was absolutely blow off top volumes and sales to active listings ratio. Then, of course, we had the COVID area, 21, 22. Those saw the fastest increase in home prices ever recorded. So, and that was also when inventory averaged around 9,000 per. Okay. So if we go back a little further, we also see that between 2010 and 2014, April inventory was around 17,000. So being above the 10-year average is good, sure, but that bar is essentially set very low because of all these extreme bull runs we've seen over the last decade. But hey, what do you do with this? What do you do as a buyer? What do you do as a seller? I think if you are a buyer, you've kind of been poking around and thinking about a home in the Vancouver area, well, you're likely frustrated with the lack of options you've seen over the last few years. Well, maybe it's time to consider another look because, as we just mentioned, there are more homes available for you today than there has been for 4 straight years. So maybe have a look at that landscape now. Sellers, of course, if this should continue, well, we've seen it before. Ultimately, it can turn into a race to the bottom. But too early to say, but you never know. But if you are a seller on the market now, maybe you're seeing that, hey, people come and check out your property, but they ultimately ended up with something down the block because, hey, they happen to price a little sharper. Regardless, I think if we see inventory continue to increase at above average levels for the months of May and June, there will be some quote unquote deals in summer because those are typically slow months. And if somebody has to sell, then buyers should consider taking advantage of that and see what's available for them at potentially discounted prices.
Yeah, I totally agree with just about everything you said there, Dan. And really, it amplifies the fact that Canada has the tools. Like we shouldn't harp on the country as being in a place where it's, this isn't something we can recover from, or we're going to see some turbulence in the near term, right? But we have all the tools, kind of like we mentioned before. We've got the resource sector. We've got all of everything we need to turn this around. The question is will interest rates do that? Or do we need a bigger macroeconomic environment change where we're going to see, the flow of business investment come back to the country, and you're going to see more people being able to get paid more? That'll service higher debt, right? That'll service bigger numbers. Right now, we're struggling as an economy and as a nation for that to take place. So, it'll be really interesting to see how things play out, I think, in 2024. I think in 2025, we'll probably see some level of return of stability here. At least I hope, unless there's some sort of black swan event, that can't be discounted anymore. Anyhow, let's look into the sales to active ratio. So overall, we're sitting at 24%. That's up 1% month over month. It's the 5th monthly increase in a row. So again, we're now in a 3rd month of a seller's market. We'll see though, as this continues to play out, when we actually look at the classifications, detached is sitting at 18%. That's the same as last month. 31% for townhomes, also the same as last month. And 26% for apartments, which is also the same as last month. So I feel like we're starting to see a bit of a tabling here. Things aren't continuing to spike like they were. We're starting to see this sort of plateau and could be a stagnant movement in the marketplace.
So what does all this inventory do to prices? Did prices go down last month? Well, the answer is kind of. And what do I mean by that? Well, HPI, which is the lagging indicator that takes the average of median and the average, and of course puts it through a hedonically adjusted algorithm. Anyway, that went up last month, but only about 0.8%. We're up almost 3% year over year and up about 4% since January. The HPI price has crossed $1.2 million, sitting at $1,205,800, $1,205,800 average price. when we look at each property type, detached prices increased, townhome prices increased, but condos actually went down. But remember, they went down off of last month's all-time high. So why did I say kind of? Well, that's because when we go down further and we look at the median and average, well, both median and average prices dropped last month. Median dropped about 11,000 to 988K, whereas average prices dropped 13,000 to $1,304,000.
Yeah, and the days on market have again, they haven't changed very much. They're sitting at 11. So again, if you've sat on the market for 20 or 30 days now, even more, maybe you're 40 days, chances are you are priced too high. And like I said earlier, this is a very price sensitive environment, especially when you consider levels of affordability. And even though we're moving real estate here in less than 2 weeks on average, I suspect this number will go up next month, but something that we really need to keep our eye on. And so bringing us to kind of what's next, well, honestly, I'm seeing more of what we've just gone through. And I think we'll see that until June, assuming that there's a rate cut in June. I don't expect huge changes in June from the Bank of Canada. I think the changes will be nominal. I think we'll see a 0.25% cut. And I think looking sort of beyond that time frame becomes really, really hard to do as we approach the US federal election, because as that economy begins to change, it'll put different pressures on our economy. It could be positive, depending on what they do later in the year. It could also be negative, depending on what happens as a result of the US election. But real change will come, I think, when our country really wakes up to the realization that we need to use our competitive advantage on the global side of the economy. I think if we look at that and we really embrace who we are as a nation, we're going to see the rest of our economy, including our housing market, kick up to where it has been historically. But until that takes place, and until we start using our natural resources like we have in the past, it's kind of an inconvenient truth, but here we are as a result of those decisions. So.
Okay. Well, that is what happened in the month of April for Vancouver real estate. As always, it is fascinating and moving quickly. Because of such a unique spike, we'll obviously keep you updated throughout the month of May here as to what's happening with inventory. Because if we see a repeat, then all of a sudden we're getting closer to a trend and things might start to get very interesting. Thank you, as always, for tuning in and watching, and we look forward to having you here again next week.